Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. And today we're focusing on planning for the end of the trade right up front. We're going to talk about planning and placing those exit orders for the potential management of profits and losses. I think this is always a webcast that's in high demand, so hope that it provides some good value to just about everybody watching. But before we can get into any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. I've already had a little bit of back and forth with our live stream attendees. Great to see Greg out there and Kevin, my friends YouTube, Richard, Eric, Scott, Chris B, JDLMI, on and on. As always, the list goes. So thanks for joining us week after week. We really do always appreciate your attendance and your contributions to the discussion. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but be aware that you're invited to join us in the live stream if you'd like to be here in with our live audience members. This is a Thursday webcast series, and we kick things off promptly at 11 Eastern time. Would love to have you here. Now, I also want to let you know that my very good friend Kevin Horner is going to be hanging out in the chats. No, is it Brent Moores? Let me just double check. It is Brent. Hey, Brent, thanks for being there. Brent and I have been working together now for more than 2 decades. So Brent brings a ton of experience to this discussion. He's going to be keeping an eye on the chat window just to see what questions come in. If I don't get a chance to answer those, he's going to be there to pick up my slack. Thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everyone watching. You should be following your favorite Schwab presenters on social media. You can find Brent and me on X. So you can follow Brent there at Brent Moore CS. You can find me on X at Cameron May CS. You can also now follow me on LinkedIn. Go to linkedin.com/in and then /Cameron May CS will take you right to my profile, and you can follow me there. But let's get right into this discussion. Of course, as we're talking about options trading, options certainly carry risk. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let's set an agenda for the day's discussion. First thing that we always do is take a look at our existing paper money trades. We have 4 in place right now. I think that at least 1 or 2 need particular attention today. Then we're going to take a quick look at the markets, see what sort of conditions that an options trader might find themselves trading in or under. And then we're going to be planning and placing a new debit spread trade. But we're going to start with the end in mind, and that is the management of potential profits or losses. So we'll talk about how a trader might plan for their entry, but also plan the exits in the case of developing profits or developing losses, and how we might enter those orders so that we have a good feel for the complete execution of the trade from start to finish. All right. So I think it's a good agenda, tall order. Let's get into it. Let's go right to the Thinkorswim desktop platform. This is the paper money version of Thinkorswim. We have 4 positions in place right now. So let's have a look first of all at NVIDIA. Ooh, look at this. This thing has been up and down right at break even, profit or loss since we opened this position. We're right there. So what is this? This is a vertical spread. Bought the 170 calls, sold the 175 calls. That is a bull call spread where we prefer to be above 175 at expiration. Expiration is 1 day away. Today is Thursday. These expire tomorrow. And the stock is at $175.27 right now. So we are right there, shaving it close. That's why we're looking at just right now marginal profit. This one actually has a maximum gain. We paid $3.75 net between the purchase and the sale of those 2 contracts. So that left us with $125 per contract, or $1,250 on 10 contracts. And right now we're at $80, 95. Here's what that looks like on our chart. So bought the 170s, sold the 175s. I just make these drawings and these text notes on the chart to help people understand where we'd like to be. Look at this. We are so close on this trade. Let me zoom in here. that there we are, just above our 175 short calls. Expiration is right there tomorrow. So what might a trader do at this point? Well, when we're this close to expiration, some traders, of course, we might have in the back of our minds, oh no, what about assignment risk? Well, these short calls, the trader is probably looking for assignment. That's the preference of the trader. In this case, what I might say a greater risk is the lack of assignment risk. If we were to fade going into tomorrow, let's say we slip back down here below 175, and we're at 174 somewhere, just below 175, but above 170, and we allow these contracts to get to expiration, what might happen? Well, the trader who has the right to buy shares from us for 175, they don't have a lot of motivation to do that because the shares aren't worth that much. So they do not assign. In the vast majority of the cases, very rare exceptions, that's what would happen there. However, our long call, we have the right to buy shares for 170 that are worth more than that. So that contract would be exercised on our behalf at expiration. And we wind up buying some shares and thinking that we're going to sell them at 175, and nope, we don't. So this might result in the purchase of 100 shares on one contract or 1,000 shares on 10 contracts. Does that put an exclamation point on what I'm talking about here as let's call it the lack of assignment risk? Yeah, we might wind up owning shares that we never intended to. And then if those shares drop in value before we get a chance to sell them, that could completely change the risk-reward profile of this trade. So let's close it up. We don't have the luxury of reconvening tomorrow to see what actually happens with this. Now, early assignment, even if we desire, it's not going to happen in paper money. It can happen in a real account, but it's not going to happen in paper money. So let's wrap it up. Okay, it looks like we're strengthening here a little bit. We might be able to pull a little bit of profit out of this trade. Let's close it out though. Right click, create a closing order, and sell these 10 verticals. Looks like our spread is pretty narrow. Wow, just 3 cents combined on this credit spread. Quite a liquid set of contracts we're trading here. Let's see, our mids at 385. Let's dial this down. Say that we're willing to accept maybe even $3.80 to close this out. So remember, we paid $3.75 to get in. $3.80 getting out would be realizing 5 cents per share, $50 per contract. Pardon me, $5 per contract, $50 on the 10 contracts. But there are commissions to be paid. A little bit would be taken out of this, but let's click confirm and send. Going to try to buy out of this. That would leave us with a net credit of $37.87. We paid $37.50 plus commissions to get in, so barely a break-even trade. It's the way it goes sometimes. Let's see if we can get out. Let's click send. Sold those verticals. Yes, there were commissions. We're done with that trade. All right, and it looks like we sold at $3.84. All right, so we made $9 per contract, $90 across the range of contracts, minus $13 in commissions, a little bit of money. Okay, so that NVIDIA trade is done. With Tesla, this is I wanted to talk about Tesla because we exited half of this position last week when things were looking particularly strong. So we own the 400 calls, sold the 410 calls. The original position was 6. We've closed that down to just 3. Now we did that. This is a $5 wide spread. No, it's a $10 wide spread. So we closed this out for $9.30 per contract. In other words, we came up 70 cents short of $10 on the verticals that we closed last week, or we left $70 per contract on the table in potential profits on those 3. That's $210. We had a high probability of success. We decided to wrap up the trade, those 3 contracts anyway. So looking at today, there is an extremely high probability of success now. So this is where the trader might revisit how they're managing trades as they're getting really close to expiration. Last week, it felt good to close out with a profit. This week, it might feel better to be closing out with a stronger profit. We don't have that opportunity on those closed contracts. So I do like to talk about that, how even when we're taking profits, that might not be the best decision. Now, obviously, we didn't know the future, and this could have reversed, and we could have been feeling pretty good about the profits that we took. But in any case, let's wrap these up as well. Now, we could just allow these to go to expiration, get assigned or exercise the 400s, get assigned on the 410s. That would be almost certainly, not guaranteed, but almost certainly the outcome. That would be a $10 gain on the shares, minus what we paid for these contracts, which was, it looks like $6.70. So $3.30 per contract realized gains. But let's see if we can close these out, or bear with me for just a moment. Yeah, it looks like we're really close to $10 on the spread. There's really not much meat left on the bone right there. Let's right click, create a closing order, and sell those verticals. It looks like we are not going to get 10.10, by the way. I know that for just a moment it looked like, oh, if we go for the mid, we get $10.10. That is, even if it looks like it's a possibility, it's a highly improbable. So let's back off on that. Let's say that we're willing to close out for $9.90. Okay, that's where we'll lock in, try to close out of these verticals. In this case, we've gone so far in the money. This is very typical. A deep in the money contract can get a very wide spread, make it a little bit harder to get these orders filled. But we'll see if we can get this filled at 990. Let's click confirm and send. Selling those 400, 410 call verticals, trying to get 990. There is a commission to be paid to close this out. If we can close it out, let's send that order off and we'll let that work. We are saying that we'll accept the credit of 990. I know that mark says 10 bucks. Nope, we're not going to get 10 bucks, or almost no chance, or more than 10 bucks, I should say. It was $10 and change. In any case, we are out of that trade. So we've wrapped up NVIDIA, we've wrapped up Tesla. We have UNH. UNH looks unprofitable. I'll tell you, UNH is not unprofitable. The current position in UNH is unprofitable, unrealized loss at the moment, but we bought the 300 calls. We've sold the 380 calls. Between those two, we're looking at a $400 unrealized loss at the moment. But the preference for the trader here, when we own a 300 and we've sold the 380s, we prefer for the stock to go above 300 as far as it can go, but stay below 380. That's the best case outcome. It's doing one part of that equation, but not the other one. Okay, so we are above 300, and especially over the last 4 or 5 weeks, the stock has been trending upward, but we're nowhere close to 380. So 380 looks okay. That looks like that's a high probability. We're not going to get there by the expiration, but boy, our 300 is just kind of stagnating. That long call is not doing as well as we might have hoped. So that's why we're looking at a $400 unrealized loss at the moment. However, we do have a $570 realized gain on 2 previous short calls. Sold some 360 calls for the October contracts. Those we realized a gain. Sold the 380 calls for the November contracts. Those we have a realized gain. So 570. We do have to subtract a few commissions there, a couple of commissions on each of those. But overall, we made over $550 already. And you set that against, oh, it looks like 470. There's a slight net gain in realized gains minus unrealized losses. What are we going to do with this? Well, the 380 call that we sold, we might be able to buy out of that for about 85 cents. I'm going to say it's so far out of the money, let's let that one continue to work. See if we can continue to collect more of this 85 cents. The long call, we're going to have to keep a close eye on this because we had an original plan to close out if this support broke, and it did, but we weren't having our webcast at the moment. So we actually missed this support break, and it started to rally again. By the time we got back to having the webcast and talking about the management of this trade, it was sort of already in recovery mode. So let's let this, I'm going to let this continue to work. It looks like we're still making higher highs and higher lows. Our trader might decide we've had a little bit of a pullback. Maybe that's just the next little retracement in an otherwise upward trend, which is potentially helpful for this long call. If that continues, I'm going to let that one continue to work with no adjustment. So that finally brings us to last week's trade, which is this new diagonal spread we put on. Bought the 330 calls for the 18th of June, sold the 355 calls for the 16th of January. Preference here is for the stock to go up, but to stay below 355. Looks like it's doing a pretty good job of that because right now we're up overall 545 bucks in just the last week. So here's our Visa position. Took that position. We really took that position right here. If you'll see that line, that's where the stock was trading at the time the webcast was held, and it just strengthened through the rest of that day. Looks like we might be making a higher low right there again, pushing toward the 355 short calls. Long calls are doing well. Short calls still out of the money. Let's let that one continue. So that's it. We're going to be left with two current positions. We need to add a new trade to this portfolio. So let's go have a look at what's going on with the markets. And as we do that, let me hit the pause button on that for just a moment, because I notice here there's been a survey link that's been added to the chat window for our live stream audience. So for those of you who are here in the live stream, if you do me this favor, click on that survey link right now and then fill out the survey after the webcast is over. It's just two multiple choice questions, a comments box and a suggestion box. But I'll tell you this, if you take the time to fill out that survey, it's always helpful because they send that information right to the coaches. And I'll just tell you, I'll take the time to read through that data. I read through your comments. I was just reading through some comments today. Saw a really nice comment. Thank you. Actually, it was nice because the person said that it was a good webcast, but also it was interesting because they had done some AI search and it referred them to my webcast, which is cool to see. Anyway, so yeah, I read through that stuff. Anyway, thanks for filling out that survey. Let me go back over here. I want to have a look at any other questions that have come in. I don't think so. I think we're good. Yeah, nice. All right, anyway, let's get to the markets. Let's go see what's going on with the S&P 500. We were off to a pretty good start, and I suspect, yep, things are strengthening right now. So over this last week, we've had a bit of a sell-off, a dip taking us down to about 2.5% below those previous all-time highs. However, within the context of what we've been seeing over this last 8 months now, let's say that our trader is trying to plan maybe a new trade out here for January, and they're just trying to gauge, do we think that stocks are more likely to be higher or lower by mid-January? And looking what's happening on the S&P 500 might give them potentially some insight. Obviously, a chart is not a guarantee of which way stocks are going to go. However, it's been let's just say that our trader looks at the last 8 months. They see this pullback as sort of the breathing in and out rhythm that the markets have assumed for the last 8 months. And maybe they think we've come down to just another in a series of higher lows. And maybe they think we're ready to go up for the foreseeable future. I'm not saying this is absolutely what's going to happen. Let's just say that's our trader's outlook. So we're going to be planning and placing another bullish trade. We actually have managed over the last few months to squeeze in a couple of bearish trades. They actually both worked out pretty well. But let's go with that premise. Let's say that our trader is bullish. So let's go find a stock on which they might plan and place a bullish trade. And I'm going to do a vertical spread today. Sometimes we'll do diagonal spreads. Sometimes we do vertical spreads. Those two strategies are the focus of this webcast series. But for this one, I'm going to go back to a familiar name. We just closed out our Tesla position because it had sort of maximized itself. There's only about 10 cents left that we could have made on that. By the way, did we close that out? Did it? Yeah, we got a fill, didn't we? Yeah, that's closed. Okay. Offered $9.90 to get out, and we closed it out. So, Mad Notes says, I got here pretty late. Should I fill out a survey? As long as you feel like you can give me some honest feedback, it's definitely appreciated. Yeah. Anyway, so what has happened? We're done with this. That's historical. So I'm just going to right click, clear this whole drawing set. And I'm going to delete this vertical spread drawing set that I had previously saved. There we go. Let's just close that out as well. There we go. Nice clear drawing set. But something new that a technician might find interesting is developing as we look at this chart, and that is Tesla. Maybe it's working its way. We haven't gotten to the end of the week yet, but this might be the highest close Tesla has ever had on the end of the week, on a weekly candle. Let's look at this area that we just cleared, this previous resistance around 474. Tesla has struggled to get above 474, finally pushed up and through, and that looks like that may be acting as a new support. But beyond that, this could be the highest weekly close Tesla has ever seen. So could this be a potential bullish breakout? Could be a break of a previous price ceiling that held for really more than 11 months. This is nearly 12 months. So let's say that our trader looks at this. They think about the context of what's happening with the S&P 500, and they think that Tesla it might continue on up. Now, lots of strategies can be employed if a trader is bullish, one of which, though, is a long call debit spread. That's what we're going to do today. And I'm going to structure this one to be high probability. Let's just say that's our trader's preference. So what would that mean with a spread? Well, that means we're going to go in the money. We're going to go below the current price of the stock. And I'm going to position this relatively far below. Let's go to our trade tab. And let's look at the 16th of January. That's that next monthly expiration. And let's see how far in the money we can push this thing. Now, here's a little technique. And I'll tell you, for this webcast, I'm going to do a $10 wide spread. Most commonly, you'll see me doing $5 wide spreads. I kind of just get stuck in a rut, in a rhythm, and it might give the impression that that's the only way to do it. It's not. There are pros and cons to going with wider spreads. So how about for this one? Let's go with a $10 wide spread. And our strike increments are in $5 increments. So the spread that we're going to wind up doing is going to be 2 increments apart. So let's say if we wind up buying the 460, we may sell the 470. If we wind up buying the 450, we'd sell the 460. So they're 2 increments apart. So this is what I'm going to do. Tell me if you've done this before. I'm going to go up here where it says spread, and I'm going to use the deep and wide function. Have you used this before? Watch what this does. I'm going to go to the deep and wide, and we're going to stay with just 1 month. Both of our contracts are going to be in the same month, but they're going to be 2 strikes apart. So I'm going to choose 1 month by 2 strike vertical. And what that does is it pairs up each contract with the strike that's two increments away from it. So like now I can look at this, and this is looking at a potential vertical of the 450 and the 460, or the 455 and the 465, and the 460 and the 470. So I'm going to go to, let's just go fairly deep in the money here. I wonder how much like a 440 and a 450 strike vertical would cost us. And it looks like that's trading between 725 and 775. So if we're able to get filled somewhere at, let's say, near the middle, the mid price, that might be $7.50 to buy into this vertical spread. So to help visualize that, the 440 and the 450 spread would be down here. And I think we might, let's go for that one, I think. There's 450. I'll clean that up in just a moment. The 440 is going to be just, that feels like a long distance below that, but on this chart, it's not a huge distance. Let's go there. There we go. So that's the spread that we're contemplating. CB says, hey, Cam, hi, Cam. Hi there, CB. When do you move up stops, for example, a trade? Okay, so you're in a long call. My apologies. I don't want to get off the track of this discussion. It's a good question. but it would just sort of take us off on a tangent. So I'm going to sort of park that question. I don't ever want to sound dismissive when a question has been posed, but if it's a little bit just outside the intended purpose of this discussion, I will kind of leave those for a future webcast. It's a good question, though. All right. Anyway, Mad Notes says, why 2 increments apart? Well, Mad Notes, the trader, and I've done previous webcasts where we talk about strike selection, but with the selection of strikes, the width of the contract can definitely influence lots of things. It can influence the cost of the trade. It can influence the max gain, the max loss of the trade. It can influence the break-even points of the trade. It can influence the probabilities of the trade succeeding or failing. So I want to cover all of those in let's say this webcast briefly, but maybe go check out a previous webcast in my series where I dedicated the entire webcast to that. Okay. All right. So, CB, you say it's from my Tuesday class? Yeah, so we'll maybe discuss that in one of those classes. All right, anyway, but let's say that our trader is looking at buying the 440 and selling the 450. So creating their long vertical spread on the technical evidence of a combined set of technical evidences. Number one, the S&P appearing to be bullish, but also the stock itself appearing to be bullish, and specifically moving above what appears to be a possible area of support. So if this previous price ceiling acts as a new price floor, and all the trader needs for success on this trade is for our stock to stay above 450, well, if it's staying above 475, hopefully that's the way it goes, but that could help the likelihood of success here. Okay, Abi says, why go so deep in the money? Why not say 485, 490? In other words, or 495 up here. That would actually be an at the money position, slightly out of the money with that short contract. So the quick question is, the quick answer there is, there are pros and cons to both of those. Going at or out of the money on a vertical spread creates a lower probability of success. There's a con. But it also can dramatically reduce the cost of the trade and increase the reward potential of the trade. So if the stock goes in the intended direction, the at or out of the money contracts could be more appealing to those traders who are quite confident in which direction they think the stock is going to go. Now, going in the money can dramatically increase the probability of success, but it also dials down the reward for being successful. It increases the cost of the trade. It lowers the amount left over as potential profit. So pros and cons. It's up to the trader. Let's say a more confident or more aggressive trader might go at or out of the money. A trader who wants a little bit more wiggle room on their timing, maybe they go in the money, as long as they're willing to trade off a higher cost and a lower reward potential. Okay, Luis says, do we close it once we reach the price, or should we keep it for long? It's a big, Louis, great question, and that's what I want to talk about. So let's just say that's going to be our trade, and it looked like it was going to cost us about $750. Well, it looks like we're still in that neighborhood. It might cost us a little bit more. So let's go ahead and plan. Let's say that we're going to do that trade, but we want to plan the back end of the trade. That's the stated purpose of this discussion. Well, the trade might work or it might not. So let's have a plan for both of those scenarios. So let's lay out some facts of this trade, or at least as they appear at this moment. Let me get my scratch pad open. So our example trade, make this bold. I always like it to be bold so you can see it a little bit better. Our example trade is a debit spread, or in other words, a long call spread in this case. And it looks like the, let's see how much we might be able to get this filled for. buying the 440, selling 450, halfway-ish between 740, 790. Looks like it might be costing us more like 765-ish. Let's see. How about we say at this moment, we're able to buy it. We're going to buy the 16th of January, 440, 450 call spread. And it looks like it might cost us, how much? Let's call it 760. Prices are changing. Let's say it's 760. So if we spend 760 for this call spread, how much does that leave as a maximum gain? And I'm going to call it the theoretical maximum gain. Because as we already discussed with our other trade, if we happen to get assigned or if we tinker around with the trade, turn it into something else, it can definitely change the profit and loss scenario of the trade. But if we're spending $7.60 for the right to buy shares for 440, but someone has the right to buy those shares from us for 450, well, if these contracts wind up getting exercised and assigned, we buy the shares for 440, sell at 450, that would be a $10 profit, except it cost us $7.60 to set this trade up. So the maximum gain here is $2.40. That's important. That's going to factor into how a trader might choose to exit with potential profits. All right, well, what's the theoretical maximum loss of this trade? That's how much we invested in the trade, $7.60. So those are some important facts about this trade, assuming we're able to buy into this for $7.60. So let's talk about managing profits. 240 is the most, theoretically, that we can make on this trade. If these contracts get assigned, let's say the stock stays where it is. Here's some scenarios that can lead to our maximum gain. If the stock goes up, great. If the stock goes sideways, great. Even if the stock goes down, great. As long as the stock is above $450 come January 16th, what is almost certainly going to happen? Well, we have the right to buy shares for 440 that are worth more than that, so we buy those shares. Someone else has the right to buy shares from us for 450 that are worth more than that, so they buy those shares from us. So we buy for 440, we sell for 450, $10 in realized gain under those assumed scenarios on the stock, and we paid $7.60 for the contracts that allowed us to do this. That leaves us with $2.40. Okay, so those are scenarios where we might have maximum gain. Let me clean those up. What about scenarios where we might have maximum loss? Well, if the stock collapses in value, we have the right to buy shares for 440, and they're worth less than that. Why would we want to buy shares for more than they're worth? So we just pass. Someone else has the right to buy shares for even more than that. They pass. So this $7.60 that we spent it just expires, and we lose it in this case if the stock comes down here. So those are, if we just turn this trade on and let it go to expiration, those are some potential outcomes. Now, a third potential outcome we need to be aware of that can definitely happen, because we just saw that on our NVIDIA trade, we were teetering on the edge. What if we come in between our strikes at expiration? What if we're at 445 at expiration? Well, we have the right to buy shares at 440. They're worth 445, so we do it. At the same time, someone has the right to overpay us for shares they're only worth 445. They have the right to buy shares from us for 450. They don't do it. We wind up buying those shares, spending a lot of money, tying up a lot of potential capital, and exposing ourselves to new risk going forward. That's a possible outcome. Winding up with share ownership if we're in between the strikes at expiration. So maybe a trader might want to have a plan for the management of each of those scenarios. So okay, Roger's saying, is it better? Anytime it starts off with, is it better? That's a great question But knowing whether one way to trade was better than another way to trade is determined at the back end of the trade, not at the front. But here's the question. Is it better to buy deep in the money calls or one at the money and one out of the money? How can we decide? Again, Roger, that actually goes back to a question that was asked earlier. It's a good question, not the topic for today's discussion. I have addressed it in the past, though. So if you need to see that, what you might want to do is go to my playlists of previous webcasts. And by the way, if you haven't subscribed to our Trader Talks channel, you might want to do that right now. Go down, click on the subscribe button. It only takes a second, doesn't cost anything. But our YouTube channel called Trader Talks Schwab Coaching Webcasts is where you can join our live streams. You can find our previous webcasts. And that's the important thing right now. If I scroll down our list, we have lots of webcast series. Here's my long verticals and diagonals. View the full playlist. What you want to do, what in the world, I accidentally clicked on one. Anyway, let's close that out. Let's do that one more time. View full playlist. There we go. Scroll down through and look for strike selection. Okay? And I just talk about pros and cons of those because there's not a better or worse. There are pros and cons to each strike selection pairing that we might choose. So, good questions. But let's get back to our trade and let's talk about the management of profits or losses. And what you may notice is that with these vertical spread configurations, when we go in the money, there are smaller profit potentials than the loss potential. Okay, let me highlight the right one on the loss potential. So let's say that our trader is looking to optimize this, get as much juice out of this as possible while trying to minimize this. So let's say that our trader, maybe from the moment they take that trade, if there ever emerges a condition where they can get, let's say, 80% of that maximum gain, and that's just an example, not everybody does it this way, but I want to put in an example percentage here so that we can run some math and enter orders that will help us accomplish that. Well, let's say we'll be happy with, it'd be nice to get $2.40, but if we can even close out the trade with 80% of that, we're going to do it. On the other hand, let's say that our trader, in their effort to minimize the loss exposure, they want to have a second order where they want to close this trade out if the stock starts misbehaving, if the vertical spread isn't working, and if their investment is starting to decay rather than grow. So let's put in maybe a stop at 50% of this maximum loss. These are just example percentages. Again, other traders might decide to do these with different percentages. But how would we do this? Here's the calculation. So what's 80% of 240? 240 times 0.8 is $1.92. So if we're buying at $7.60, this might be our limit order. We buy for $7.60 and we want to sell if the contracts have grown by $1.92. There we go. So we're going to plan to close this out if we can do it for $9.52 or more. Does that make sense? If we buy for $7.60 and we sell for $9.52, that would be a $1.92 profit, or in other words, that's 80% of our $2.40 that was the maximum we could have made, theoretically. Well, we're also going to plan a stop order, and this one's much more straightforward. If we are able to buy the contract for $7.60, let's just multiply by 50%. You know how this works. We could either divide by 2 or multiply by 0.5. In any case, that's going to be $3.80 where we're going to place our stop. That is going to be the trade management plan for this trade, where we're not requiring that we make maximum gain. If we can just at any point between now and expiration close out with most of that, we're going to do it. We're also not going to, we're going to try to avoid absorbing maximum loss. If the trade just isn't going the right way, we're going to close that out at 380. Roger says, we base our limit order on option premium. Is there any time we rely on stock price for this trade? Roger, we could. There's definitely a possibility, though, the stock never goes to the levels that we select. So, yes, there are ways that could be done. But in this case, let's tie it to the value of the investment. Okay, so let's go to our trade tab and let's place these orders. Let's see, first of all, does it look like our price is about right? It looks like actually might cost us a little bit more. Let's see. Let's see what we can get. Oh, that, of course, the spread widens just as I'm talking. But I'm going to right click on our 440, 450, right click right there. Actually, let's just left click on the ask price and create our buy order. Okay, here, the trader needs to calculate how many contracts they want to buy. And with the natural, let's maybe say that we're willing to spend up to 770. That's going to change our calculations slightly. Okay. But let's put in a maximum that we're willing to spend of 770. And assuming we're able to get that filled, let's also attach 2 sell orders. So if the first order fills, we want that first order to trigger what's called an OCO order. This is going to allow us to put in 2 sell orders. But if we pay 770, that's $770 for one vertical spread. We typically keep our investment to $4,000 just in this webcast series. So how many verticals can we buy? 5. So let's make this 5 contracts. Now, let's do some quick math here. Let's get out our calculator. If we spend 770 instead of 770 or instead of 760, let's multiply this. That would leave us 230 that we could make. Multiply that by 0.8 to figure out the profit that we'd like to make, $1.84. And then $1.84 above 770 is an exit at 954. You can see how little that actually changed. But how do we enter that order? Well, we go to the original purchase order and let's create an opposite order to close that out. This is going to be a limit order. Buying at 770, we want to sell at a limit of 954. Let's make sure that's a good till cancel order. So we're just saying this is the least we're willing to accept as a credit to get out of this trade. Now we also want to have an order in case the trade isn't working. So let's go back up to our original order, right click, and create a second opposite order. And this is going to be our stop. So half of 770 is just going to be 385. That's going to be our stop. And we'll make that good till canceled. So now we have trades in place for the potential management of both profits if they arise and losses if they occur. So let's click confirm and send and see if we can get this thing filled. We're going to attempt to buy 5 verticals for 770. We're going to sell those. If we can get 954 for those, that'll close it out 80% of the way to its maximum gain. Or we're going to sell if the value of our verticals is falling for half of the value. Now, there are commissions to be paid in each of those scenarios, and a stop is not a guarantee that we will execute at a specific price. But let's see if we can get that filled. And we did. Actually, look at that. We bought at 755, a little bit lower price. So there we go. So, guys, we've accomplished what we set out to do today. Chris says, is there a way to set up the stop to avoid or minimize the volatility risk in the bid-ask spreads around the market open? Chris, we couldn't do that every day. So the short answer is no. We could avoid that maybe for one day, but not on a good till cancel basis. In any case, guys, we've set out what we've done what we set out to do today. We planned and placed a vertical spread, but with a plan to manage profits if they emerge, and hopefully a plan to manage losses. Obviously, that stop is not a guarantee that we'll sell at that specific price, but hopefully this is helpful for you. It's a common question that arises. I see it in my comments all the time. How do we enter the back end of the trade up front? There we go. That's one way that it might be done. Lots actually different ways that we might do this. So maybe we'll explore those in future webcasts. But guys, thanks for giving me your time today. I'm going to let you go enjoy another webcast. I'm going to be back in a couple of hours, a few hours, to talk about credit spreads, or I think I'm going to stick with a theme for that discussion. So if you want to see this on a credit spread, come join me in a few hours. But also, make sure that you have subscribed to our Trader Talks channel on YouTube. If you haven't done that yet, you can just pop down, click on the subscribe button. But our YouTube channel is where you can find our previous webcasts. You can join the live streams. You can even do keyword searches through our archives. Also, make sure that you're following your favorite presenters on social media. You can follow Brent on X at Brent Morris CS. You can find me here at Cameron May CS. And if you replied on my posts, I try to reply right back to you. You can also follow me on LinkedIn. Go to linkedin.com/in and then add Cameron May CS. That's my handle there. Give me a follow there. But everybody, thanks for giving me your time today. Go fill out that survey if you would. I will read through your comments and that data. It's always helpful. Thanks for all the likes. That definitely helps, and it gives us a boost in the YouTube algorithm. But guys, I will see you again in a few hours. I'll look for you in future webcasts. I'll also look for you on social media, on X and LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.